as you know, there's a point in a startup where kind of not enough people believe in it. And it's kind of like a bit of a struggle to get believers. And then there's a point where, and it can happen quickly or long, where everyone believes in it and it's overcrowded and it's like swarming. We tend to only focus on like the super popular, everyone's trying to get in and you're pushing each other out and there's only like one person standing. Okay, that's just like cool to talk about. What about the phase where there aren't enough believers and you're culling around and they're like, oh, who's this? Like there's tons of room for collaboration because there's tons of help the startup could need, tons of value. And I think that's where you can leave a high impression. So as an emerging manager, I would argue you probably leave a higher impression on the founder and build your brand more by contributing when no one else believed.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how venture capital is changing from the emerging manager perspective. We'll be talking with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, our guest is Lyon Wong, the co-founder and CEO of V0. Lyon has a breadth and depth of experience in startups and venture capital. He was an investor at Lightspeed and Spectrum 28 and also co-founded Blameless. With a background that spans early-stage investing and building innovative technologies, Lyon brings a wealth of experience as both an operator, founder, and investor. Thank you, Lyon, for joining us.
Thanks for having me, Tim.
Lyon, can you please share how you got into technology, startups, and venture capital?
I did start a software company before going to Waterloo, so before university. I didn't think of it as a startup at the time. It was just a business. My goal is just making software. I want to sell it because I want to pay for college. Like it wasn't dropping out of school like is popular or trying to get it funded. It was like purely how do I deliver something it was for small businesses that small businesses wanted. I think that combination gave me the foundation to lead into the first place I decided to join, Microsoft. And I think there I would say is like the maturity of my view of technology, which is at that time was around invention. I think a quote that I took to heart was the best way to predict the future is to invent it. So I lived with that mantra for a while. I was like, I'm going to join here. Microsoft Research was a team I respected greatly. Ton of great research, and it still does. Huge budget and some of the smartest people in the field. So being there exposed me to is like living in the future. I was 8-9 years in the future consistently. What I ended up being surprised about is a lot of that research never made it into product. And that was a whole new exposure for me. That's not technology related per se. It's like big team, big corporation. It just didn't manifest. I think that was the inkling of me being exposed to startup. I remember the first startup I was exposed to was actually an acquisition made by Microsoft. And the founders came, and there were several that I got exposed to over time, but they were just a whole different breed of performer. They'd come in and be like skipping meetings, and it's like just like whatever red tape is there to be cut. It's just like they're here to get stuff done. That intensity was just like, wow, a breath of fresh air. It's like you're not bogged down by like the 12 levels of management within Microsoft. These people were CEOs, and their companies got acquired and they became teeny tiny teams within the context of Microsoft. But for me, seeing them in action was like, this is how real shit gets done. I could see how a small team delivered this tool set or this thing that like would have taken a massive group within Microsoft. I could see why they acquired them. And then so that's what first got me interested in the idea that startups can be as productive, if not sometimes even more productive than even at a big company. And I think that started me on the path of transitioning that, Microsoft, while the research was great, Microsoft as a company, like, can it really innovate at the pace I expect for it to shape the future? Definitely not in all the teams that I was exposed to. But startup, I feel like, okay, now that has a chance. So that's kind of how that transition came about.
We interacted on, I want to say, admittance day at Stanford Business School. Like, that was our first interaction, I remember. But throughout Stanford Business School, I got the firm impression that you were a startup and venture capital person. Second year, you were the co-president of the Venture Capital Club. And through post Stanford Business School, I've seen your career go from Lightspeed to S28 to Blameless. Can you walk us through that decision to go back and forth between startups and venture?
Yeah, I think as you know firsthand, they're very interrelated, or at least good. If you're good at it, they should be interrelated. How could the investment activity be divorced from the motions of going through building a company? Like, you need to know that in order to know when to help, when not to help. So you have to experience both. Not all startup founders need to become an investor, but such a natural extension, because you're seeing other products that are exceptional, selling to the same customer base that you are. You're seeing other founders that are maybe like adjacent to you, that are exceptional. And then so it's such a natural extension. You're in such a good position to invest when you're a founder versus when you're trying to just be an investor. And you're in such a good position to be an investor if you're building something, then you're just not building and only being like a judge or evaluator, an analytical person. So that interweaving I've always seen as being very connected. And that's why, while I chose more of the venture path, you saw me pursue more of the venture path in business school, is because I had less exposure to that. That was one of the reasons why I chose business school, is to build up that side, because I felt venture is very much about network and momentum and that foundation, versus the startup and technology side. I really had those parts understood in terms of product and technology and innovation. What I lacked was the market cracking the market distribution on any given thing. And I think that's the thing I wanted to learn. And then venture, I initially saw as the way to assess what markets are even worth cracking and solving, with the idea that I would go back and then choose one of those markets to go and build another company for.
And fast forward to V0, it feels like it's a combination of those two backgrounds, startup and venture capital. Can you talk more about what you're building at V0?
Yeah. So V0 adds a third element, which I only learned over time, this invisible force in the venture ecosystem, the LP. So there's the GP investors, there's the founders, but then there's the LP. What role does that have? And I think V0 is bringing in all three of those into the venture as a connected. You're more powerful if your LPs are aligned with the GP. Why? Because GPs are going to have ups and downs. Why? Just like the founders are going to have ups and downs. So any given quarter, any given year, is everything going to be up and to the right? No, very few companies exhibit that. Funds. Is your first fund guaranteed going to be 8x? No. Do you want your LPs bailing out on you because you did not deliver a great first fund? No. You want the long-term support, just like you want your board member, your investor, to be there with you when you have a bad quarter. But the cycle is much longer. So the goal of V0 is to really create that strength of alignment I feel you get from, if you have long-term supportive LPs, then the GP can be themselves, invest courageously, take bets, and if they're early in an industry, not get penalized for that, but continue and invest with the confidence that you're supported. Just like a founder, you're pursuing a market, you run into challenges. Are you going to pivot? You're going to get a ton of pressure from your board to hire an outside CEO, pivot, abandon because you had one bad quarter, or are they going to say, stay the course? What have you learned? Get better, and like we got you all the way. So that's really the genesis of what V0 is to bring the LP into the picture and say that LPs can support emerging managers, because I think venture is a changing landscape, and emerging managers have a thesis that is much more needed in this new world than it was before. So who has the ability and time to review the quality of all these new emerging managers? And emerging managers, not just Fund 1, but even Fund 1, 2, and 3. It's still too early in reality, even by Fund 2 or 3, to say, that's it, I've proven my skill set and like I'm no, it's still very early. All those are still emerging from the point of view of an LP.
Your background feels like it is perfectly positioned to do V0, given your experience on startups and venture capital. What insights or lessons learned are you applying now to V0, given your time at startups and all these venture capital firms, and including starting your own?
Yeah, I think a lot of the principles do apply. There's the founder market fit to ask, do I bring a certain set of unique things to the table to bring together like a part of the market that was maybe more fragmented. There's always value in consolidating a market that's fragmented. Our LP is a fragmented market. Yes, for the most part, they operate very independently, and especially around when you go below institution for families, they're global, very distributed. But all of them have a high interest and a lot of capital to deploy into venture. The friction is, how do you do that efficiently? So there's the consolidation. So those are direct lessons from learning how to look at a fragmented market and bringing it together. Then I think on the operational side, that's where a lot of the startup experience comes in, which is, how do you solve this problem not by just hiring another army of analysts, associates, and the traditional solution of a law firm, and say, I'm just going to hire a lot of people. I'm just going to become 1,000 people to do this analysis. You ask it the way a startup founder is, how can I not hire anyone? How do I build a product? How do I engineer a solution to this so that it gets done better and better? And especially in this day and age with the AI and the agents, you must start with that. And I think that premise comes from the startup world, which is the default answer is no to just building a traditional type of massive 200 person fund or fund to fund. The default answer is what can we build as a product to make that possible?
I believe through your experience in venture capital, you understand both the LP side and the GP side. And then through your startup side, you understand obviously the technology side and dealing with venture capitalists. And given your breadth and depth of experience, what do you think contributes to successful emerging managers?
Yeah, I think that's what motivated me for V0, which I think the emerging manager is like the early generation of startup founders, where you come in and you have what it takes, but then the playbook you're running, unknown to you, is very generic. Like, you're coming in with, I'm an emerging manager, I have a great network, founders love me, I have some success. Unbeknownst to you, as an LP, every emerging manager is saying the same thing. I have a great network, they love me, here's some references, I have some success. That's the perspective shift. And what you want to do, just like when you work with your founders now, is you want to encourage them to have the courage to be themselves, be distinctive. What really is your moat? Don't follow any pre-assigned formula. I must grow the fund by 2x within like X number of months after my initial deployment. Like, why do those outside parameters, which are outcomes that are somewhat really beyond your control, affecting how you're operating? Like, what are you being the best at? What network are you really the best at? Which type of founders do you earn the utmost respect? And where you add so much value, where it doesn't matter the prior history of other funds. You're an emerging manager, so you have no history, you have no brand yet, where you will still be competitive. Like, having the courage to know that you can build that out, be yourself, be the best, have the support. That's the advice we give founders, right? Because we know that's the way. But I think for emerging managers, no one's told them yet. And that's our goal, to be like that early investor, early VC for the VC, the good one that tells you, you know what, just focus on the thing that you're going to do exceptionally well. And don't worry about the vanity metrics of just how big your fund is. don't let that be the first thing that comes out of your mouth. It's like, let it be like, I was the top contributor to the success of this company amongst every other investor. I was the first and highest contributor to that. And I have a distinct view where I took that, I learned, and now I'm even better. Now my next set of advice, my next market is even better. I've learned more.
Great. That's really, really helpful. And I strongly believe that courage and confidence is really important for emerging managers. You've co-founded both startups and venture capital. What are the differences that founders need between those two? Because it feels like it's very different skills. But maybe it's not.
For a certain type of venture, it's very different. Like a large institutional venture, I do think that's very different because you need to inherit a long track record, long brand. You're building a partnership which has a certain like paper credibility, and you have relationships with institutions, and you're investing and operating in a way which is tightly bound to your institutional pool of capital, and you're fairly large. So I think that founding a fund like that and operating it is very much like the first generation, where you're building a massive brand. You're building, and you need to market that brand. And then in all channels. That's a certain type of venture. I think there's another type of venture which is evolving because the underlying startups are evolving. Less so are it's about because there's so much vertical startup, and the vertical SaaS world is lending itself to evolution. That requires a lot more technical depth. You can no longer skirt by on metrics and be like, oh, okay, within 1 year you grew to 10 million or 20 million, 30 million, that means you're good. No, like if you don't know underneath what's going on and understand, have that depth, you will lose quickly. Like you won't get past the plateau of it actually exiting. So I think that in the new world, there's a class of venture which is better suited for solo GPs, small GPs that are very precise and very networked, very specialized, and you need many of those. And that is much more similar to a startup founder. It's motion. You're not doing these you're not renting very expensive offices in the South Bay. You're building this presence of formality and richness. You're actually there contributing on the ground, and that's a very different motion, and that motion is much more similar to a startup founder. So I think it converges a lot more on that side versus the traditional way of huge AUM, big fancy presence, and like dominating intellectual ivory tower thought leadership versus I'm going to help you like succeed.
Get your first
step
customers.
by step. Yeah. So very different. And those larger firms hire a lot of people to do that. But it goes back to the thing of, well, then you're hiring a lot of people. But here, like as the solo GP or like the founder of an emerging fund, it's all encapsulated. And you do get super human performance in that, just like a founder does. The power of a founder is like, it's so concentrated. And you get that in the emerging funds. Like that, they're bringing so much more than anyone you could hire at a large fund. That solo GP is going to outperform. It's just they have so much more on the line, and it's so much more integrated. So
I want to double click on that because in 2024, last year, we saw what many people say is the bifurcation of venture to what I've now heard is franchise funds. So the General Catalyst, the Andreessens, the Lightspeeds, raising mega funds, billion-dollar funds, and then you have emerging managers. Do you think we're going to continue to see this bifurcation, and that venture is really multiple, in some ways, asset classes within an asset class? What's your prediction on venture, not just in 2025, but maybe 5 years down the road?
Yeah, I think that I personally see that increasing, the split, because I think the larger funds have a really anchoring purpose because the institutions look for something different than pure performance, and for right reasons, because they're custodians too. They have different metrics. And I think the trust built around those will attract more capital into venture, which is exceptionally important as companies evolve and the later stage. I think the early stage is where you have a lot more room to further split. Going from not funded to a $10 million seed round is a huge leap. Just because you shouldn't have 48 months of runway exiting the seed, in my opinion. I think you should have what you need to get to milestone. I think if you have the confidence and support, you know you can get to the next milestone with less than 10 million. Depends what you're building, like in general. So I think there's a lot of room to have the early stage be more layered and tiered rather than going for such a large seed round. And in that sense, it makes sense to have more specialized investors. Get to those intermediate milestones, first customer, first kind of repeatable sales motion, and these things, all before the key milestone, which would trigger the larger rounds. Because I think what you call the franchise funds or the larger funds, they invest later, but not that much later. They're ready to go at the new definition of the Series A, which is maybe like a 20, 40, $50 million round. So it's larger, but they're ready to go. So there isn't that much gap. It's not like those funds are waiting until the Series B. They're still very assertive. So that, I think it's the early phase will phase out. And if you're kind of in the middle, like lingering, and you're trying to be a Series A investor, but you're really not big enough, I don't think you have the staying power to really grow with the company long term if you're too small. So I think there's a group of funds which will like need to downsize itself, which funds rarely have the discipline to do. Whereas when you advise a startup, if they have too many people on the team, you advise them to shrink the team. That should happen to funds, even though they rarely do it. It's because their ego is tied to AUM. Even though they should actually reduce the AUM to increase performance, I think you'll see that that's the right thing to do for some funds, and whether they do it or not will determine whether kind of an LP looks at that fund and be like, oh, really? Like, do I feel you can return this multiple on this size of fund? If you were a fifth of the size, I think you could, and then I'll put my dollars there. So, yeah.
So, thank you for that. I want to double click even more on the emerging manager and that bifurcation of venture. In 2020, 2021 was this explosion of emerging managers. And now there's some concern that these franchise funds are taking all the capital and it's much harder to raise as an emerging manager. Do you think it's going to get easier for emerging managers, or do you think this is the new normal?
I think it's, when you look at, as a GP, when you look at the LP pool as a single unit, that is a failure mode. There are many different types of LPs. I think the institutional LPs are highly unlikely to choose an emerging manager. And that trend will likely continue, if not further, because a various set of factors. What else is in their books, the percentage to venture, and the risk they're able to take, the pressure on that. So expecting to compete for institutional capital against a very well-established fund as an emerging manager is risky. But LPs have other segments. Let's go to an easier, accessible one. Other founders, successful individuals, writing small checks, sub 1 million. As an emerging manager, do you have the support of those people that they recognize your network, your contribution? Yes, you can get a list of those. Is there any shame that you have 50 investors to do a $50 million fund versus one investor giving you 50 million? There is not. But I think there's artificial ego tied to, was it an institutional investor? Was it that? But those are LPs that are arguably more suited for emerging managers. And that, I think, drove a lot of the 2020, 2021 boom, actually. That boom is artificially created, not because institutions just said, we're just going to pour money into emerging managers. It's because exit events during that time made a lot of wealth, and those individuals are like, well, I'm of course going to invest in the smartest person I know who's now becoming an investor, because startup was took a long time, was a lot of work. But I think there's a third category of LP which has been moving out of the larger funds, which are the family offices. I think for those, they are well suited to invest in emerging managers because they're very performance oriented and they are very long-term consistent and they write larger checks. So if you're looking at an individual, they might write like $1 million. Family offices will typically will write between 1 to 15. Institutions will write 30, 50 million plus. But I think it's about your fund size. As an emerging manager, if you're coming out with a fund that's like 500 million, then you need a different makeup. But if you're coming out with a fund that's 100 million, you can really choose different sets of LPs.
I want to provide some anecdotes from my perspective of talking to some institutional LPs. One of them, when I talked to them, this was a state pension, said, we don't write checks under $100, $150 million. And we don't want to be more than 10% of the fund. So that means there's only a few franchise funds that they're going to be in. And then I talked to another large fund pension plan, and they said, okay, let's be candid. I want to be candid with you. We know there's no way certain funds are going to work as hard given how large their AUMs are. And I don't think they wake up for checks that are under $10 to $15 million. And I think that's right, because when I think of some larger funds, like because of their scale, it only makes sense to write $10 or $15 million checks. And so sometimes I tell the founders that we back that like there's certain funds that will go through our fund in a matter of days. And so it's just interesting that venture is such a different, we're playing almost different games.
Yeah, you're right. I think the name venture encapsulates a lot, and it's all in those details and specifics. If you look down into it, there's actually different motions and different purposes and different stages of the venture life cycle that funds are really targeting. And I think the key is to stick with what you might do best rather than all trying to converge and become the next Lightspeed, the next Sequoia, the next benchmark. And if you're all trying to replicate that model, then you need to replicate a lot of the LP structure in those ones, but then you need to replicate that history and track record, which will take a very long time.
Take decade, at least.
At least, yeah.
Can you talk more about how V0 interacts with venture GPs, VCs, and then maybe also how you all interact with your LPs?
Yeah. So we operate like a fund of fund. We've selected a really high quality set of LPs that are long-term committed, that have operational backgrounds we think are interesting, and that we think will have generational impact. Then for GPs, we're a fund of fund. We've consolidated that into a single decision making. And I think that provides but we do so in a way that gives credit, I think, to the work that GPs do that's often invisible, which is we go beyond just looking at the data and the fund track record, because especially if a lot of it is emerging. I think a lot of feedback we get from GPs we talk to is like we do better diligence and deeper diligence than any other LP they've met. The reason why is because that training comes from us diligencing founders. And founders are very good at overestimating their annual targets and having big visions that are somewhat audacious, and you have to sift through all that, right? So after all that training, we're very good at that. And I think that diligence shows that we care. So for ones that we select, they feel relieved. Certain questions we ask, they're like, no LP has ever asked that, but that's actually really critical to how this investment was made. And I think that's really appreciated. So we hope to be not only investing as ourselves as a fund of fund, but hope to be a way that GPs can be recognized, emerging funds can be recognized, that meets an even higher level of standard to show that this investment isn't just from individuals that you know and in network. This met a very high quality bar. Let's say like it's an Olympic quality bar, and that it meeting the standard represents something that others can look to and trust and invest directly in. So we hope to be kind of a standard bearer for that and have other family offices and others be able to follow suit. And then in time, maybe, I think as an LP, it's very collaborative. We will openly share our feedback and diligence with other LPs because it's not as competitive as your GP round. There's no such thing as I want to hoard out this fund. I'm the only LP in this fund. It's rare that I want to do that. I kind of want to bring on other LPs I like, and we're going to invest in a series of funds together. So we share that diligence with them, and it's like, hey, we've done our work. This is a great fund. Here's why. Here's things that you may not see on the surface because we are insiders in the Valley, and this is what gives them credit for what makes them truly exceptional. And we have a very high success rate when we, for other families we collaborate with, because that's diligence that goes beyond the data room. It'd be like investing in a startup and only looking at their investment deck and then being like, okay, I've made my decision. You've sent me the deck. I've looked at it. I've decided to invest XYZ. Like, that only gets to a certain level of depth.
So for GPs who are fundraising, because GPs are almost always fundraising, that's a fair bit of the job of venture capital, fundraising, sourcing, selecting, supporting. What is your sweet spot for GPs? Like, do you all want to engage with GPs that are only on Fund 1, Fund 2, Fund 3, or is there a certain AUM? Like, what's their ideal strike zone for GPs?
There's two answers to that. For us, for me specifically, I am focused on earlier emerging GPs in earlier stages. They don't have to be really emerging, but the fact is that when you start off in the early stages and you're very successful, scope creep comes in and you become a later stage investor. You naturally add on all these opportunity funds and so forth. So it just generally is rare that you're very successful and you remain small and early. So by definition, that's the group, because my skill set is assessing that initial connection with founders. So that happens at the pre-seed, seed stage. However, other partners on the team, they have different expertise. So they'll invest in later stages, all the way up to some of the partners on the team are very experienced looking at the public market and what has really strong IPO potential. So they'll look even as late as crossover funds. And while my construction of the fund-to-fund portfolio may skew early, we have, as I said, we'll share our diligence with some other families that have a different risk profile. And some will prefer the later stage funds. They're still smaller and they're rare to come by, a later stage fund that's like 500 million, but they do exist. And then we'll share that and then kind of collaborate to do that. I'll invest a smaller percentage and they'll invest a lot more. But in the earlier stage ones, maybe I'll invest a lot more and they'll invest less because they're more risk averse. So kind of that's how that has been, at least in the past year.
So if I'm a GP and I'm raising capital and I meet potentially a family office, and is there a good chance that they say, hey, go talk to V0 because we actually invest out of V0? How often does that happen? Because I'll for certain GPs, certain times when you talk to LPs, they'll say, oh, go talk to Cambridge Associates, or go talk to our consultants at Axia, or so on and so forth. Like, have you started to see that type of deal flow?
So we make independent decisions. So I think in that scenario, the family office would still be making their own decision. We are a peer to that. So they might ask us, have we evaluated this fund? What's our take on it? Did we decide to invest? And then we would share that if we feel it's, we'll share what's suitable so that like we want to invest together. I think that gives confidence and it amplifies the effect that the GP has. I think, so that's our primary mode of operation. What we do want to say is GPs can come to us, and then that once, the thing is, we, like any good VC, I think, is giving clear feedback on where you stand. Where does your fund truly stand against other funds? And why is it not being picked up by the LPs. What is it not working? What's working? Giving that feedback and seeing if you can adapt to that. If you adapt to that, you meet our bar. That like, it's an amplifying effect, which is even families that you may have been talking to that were unclear will immediately come around that. It's a kind of a signaling effect I definitely saw firsthand at when you're at a firm like Lightspeed. There's a lot of people evaluating the company. No one's making a decision. You make a lead check, and then everyone now sees that company as really great, and they all prior hesitation is gone, and they want to follow and pile on. Now they're overflowing with money, whereas before they're hard to raise that capital. Same situation for the GPs here. So I would say by starting with us, our goal is to give honest, candid feedback to see where you stand and give advice on how to structure the fund. We have a partner on the fund who's at Sequoia 8 years, and he can advise on the fund structure that will actually make you distinctive versus I think many GPs form a fund in a very generic way, and then they start working and building and investing. But actually the fund structure is not optimal because they haven't built many funds before, and they haven't planned many fund 1, fund 2, fund 3 transitions. So you lack that iterative perspective, and so that is useful to come have that in. So I would say that first set of meetings are our goal, just like as a VC investor, is come talk to us. We want to help you and your fund, regardless of whether or not we invest. Our reputation is built on, can we add value to you and like help you come out with a better fund? And we believe the long term, it's the same formula. We believe like good contributions will lead to good results in the long term, and there's nothing transactional about it. None of that has any strings attached. I just believe that we're the best LP. We're just gonna win long term. And then so at any stage of fundraising, even if it's a later stage fund, sometimes we'll advise funds to reduce the fund size, reduce the scope, reduce the theme, or to increase their aggressiveness in certain themes and say, we'll back you even if you take more risk and your initial return goes down because you're focusing on the right area rather than this slow death cycle of lack of confidence and like sprawl. That's advice we give candidly, and we've heard from many partnerships that that's very unique and very valued, and that's what we come to the table with.
Fascinating. In startups, we know there's a power law. Do you think in venture capital there's also a power law of venture firms, meaning there's 10 firms that are going to drive most of the returns?
Maybe in the large institutional side, yes, because there are those minimums, and then there's going to be like a size. There's only a small number of funds that will reach like 20 billion, like NEA and those ones. And there should be, because I think if there are many firms that are at 20 billion, the multiple on hitting a 10x on the 20 billion in a given vintage almost is challenging, like in terms of your vintage delivery on outcomes will need to produce many trillion-dollar companies during that vintage, which is hard to guarantee that's going to land in that vintage. So, but on the other end, no, I do think there is a distinct quality bar. I do feel that many people are investing but are not true VCs. Investing in a startup does not mean you're a VC. So I think there are kind of some tourist investors. They're not super committed. They don't have the time, and they aren't committed to growing. And it's kind of like they're investing because it's cool. I think there are a lot of those. Then there's a segment that are very dedicated. It's a craft. It's a lifetime dedication to be a great investor. And I think it's not a power law, but it is a small subset. I would say it's more of a top 5% thing, top 2, top 5% thing. It's not like 10, but it's definitely not what we see today.
And so if it's a top 2, top 5%, how many firms do you all typically review before you make a selection?
That is contingent on the fundraising cycle, which we have no control over. So on average, we've reviewed, say, 300 funds, and we selected 3. So I can't guarantee that that's the ratio. It's just the fundraising cycle. And I think it moves in waves. So in certain vintages, there will be more. That seems to be about right around that. That's slightly higher than the number I quoted. That's 1%. So it seems a bit low. But I would be open to it being 2 to 5%, all within band of that. Maybe I've been a bit more conservative because the vintage we're seeing now is like rolling off of a vintage of 2020, 21, and you have it's a lot of inflation. A lot of funds have not had the discipline to mark down their companies, so the ratio is lower because of that.
Fascinating. Can you share, say, of those 3 funds, what stood out for you in terms of those opportunities? Was it emerging manager? Was it a spin out? Like, what are those characteristics?
Yeah, there were definitely emerging managers. I think there's funds that became more focused during hardship. I think that's a quality that we definitely look for in founders, but is rarely applied to funds, which is, what do you do in adversity? Do you crumble? Do you grow stronger? Are you anti-fragile? We saw one of the funds do that. They're a very high-performing fund. They still did well, but not as well as their peak. And they're going to be more disciplined. You see that discipline applied to the AUM, to the team, to focus. So that was one aspect that I think was distinctive. And it's instinctively something you look for in a founder, but like rarely do you apply on a fund, because I think the fund is more fluid in that you can't even pin down. There's no guarantee that 10 years from now, the partnership is what it was 10 years ago. And because of that, you don't know what you're dealing with. There's a chance that half of the partnership is different. And that's very weird to assess. Whereas you're dealing with a set of founders in a company like 3 years from now, which is like equivalent time span for they better be, if I don't expect those 3 or those n number of founders to still be there 2-3 years from now, I'm likely not investing if I know already they're not going to be around. So I think there's that characteristic was one of the funds, which is anti-fragile, high learning ability, and you've already seen the adaptation to the market, very strong. The second was the opposite of that. Very disciplined and consistent throughout like the bubble. And I think that consistency seems lackluster, but it was actually rare because there was so much FOMO and pull, and they became very disciplined and very anchored in how they operated. And I think this is where fund structure comes in. It's confidential, so I can't reveal it, but they have baked into the fund design a sense of that stability and continuity that other fund structures do not have. And by that, I specifically referred to succession. They had exceptional succession planning and execution. And that's something I think few funds are good at or put explicit time to. And rarely do they follow through and execute that well. So that was the characteristic of that second fund. Third fund was an emerging fund. And for the emerging fund, it's a lot of it is how it's kind of like assessing a founder. It's not about the metrics, so it's not about that. It's about the intensity of the community built around and the clarity at which they are adding value and doubling down on how they add value as an investor, as a board member, and then that it's just this that they rank highest amongst the founders and to-be founders that are going to emerge from that community. You know that they are the go-to fund for that group. So, and that is a relevant and valuable group and valuable proprietary network. And even though a lot of other people may want to kind of chase after that as well, you know that they have earned kind of the love of that group, and that's very special. So I think that was the characteristic of the third fund.
Fascinating. One, I want to go now to the LP base. And so increasingly, when we talk to Hans Tung, they rebranded GGV to Notable, and that's because of global politics. And we're seeing that even in the dual-use defense tech space of like, hey, are you taking capital from certain countries, China, Russia, etc.? How do you think of your LP base, and do these issues of around who your LPs are, is that issues you all face too?
So I recently became an American after being a Canadian. So as a part of that, I remember
Congratulations.
swearing the oath and like allegiance to the flag, and I really thought through all of what that meant. And I do think there is a there are things that need to be protected in terms of information that shouldn't be compromised. I invest in defense companies. I invest in space technologies. And I think there's a certain amount of discipline needed to say that those companies work with the government and they choose to, they need a certain level of protection and confidentiality. And I think that that needs to be upheld. So I definitely see that. Then there are other companies in other sectors, which is just about like global competitiveness and so forth. And I think there is where I think it used to be a very global world, meaning when I was at Lightspeed and looking at all the other brand name funds, everyone had global investors. And by global, I mean European, Middle East, China, Japan,
India, Israel,
like global. And there's no boundaries, including Russian investors, et cetera. So all the boundaries we see today are somewhat new. If you take the old generation of firms and you listed out all the LPs, you're going to see every single thing that is excluded now, not permissible now. They're LPs in many of those funds. Now, so have things changed and has an impact? Absolutely, because I think there's a lot more scrutiny on the region and those ones that comes in. So yes, I do think it's had an impact on how and where funds seek to raise capital from.
When we interviewed Kathleen Estreich at Pear VC, what was fascinating is she went from emerging manager to an established fund, Pear VC, and then she's doing part of her job, not all of it, is selecting emerging managers to partner with. Do you see either of those trends happening, increasing emerging managers joining larger funds? That's question number one. And question number two, larger funds looking at investing into emerging managers.
I don't know the answer on the first one. I think that's very individual. It's like, do I see myself joining Microsoft again? I know the answer for myself. However, do I see someone going back to Microsoft having left? Yeah. So I think that's very personal in terms of that move. I definitely think they're very different, like an established fund versus emerging motion. So I think there's no like clear like what's better or worse. I think the second one on is there collaboration. I think, as you know, there's a point in a startup where kind of not enough people believe in it. And it's kind of like a bit of a struggle to get believers. And then there's a point where, and it can happen quickly or long, where everyone believes in it and it's overcrowded and it's like swarming. We tend to only focus on like the super popular, everyone's trying to get in and you're pushing each other out and there's only like one person standing. Okay, that's just like cool to talk about. What about the phase where there aren't enough believers and you're calling around and you're like, oh, who's this? Like there's tons of room for collaboration because there's tons of help the startup could need, tons of value. And I think that's where you can leave a high impression. So as an emerging manager, I would argue you probably leave a higher impression on the founder and build your brand more by contributing when no one else believed than when trying to claw your way in when the line is like now super busy. So I would say if there isn't more collaboration, I think there's definitely room for collaboration. And I think the LPs would support. LPs obviously like things that are hotly contested. Who doesn't? You want to have something popular. But I think that my view, I want to support funds that are impacting founders. And all founders know they're going through a phase where they're not popular and they're trying to build up towards that hype. Who's helping you then? I care about that. And I think that people should not forget that that's a valuable place to spend your time. And it's, I think, a collaborative like time.
One thing I find fascinating around V0 is that it is a fund of funds, but it is taking a fund of funds approach with trying to leverage technology. Can you talk about the technology aspect?
Yeah, I think we're seeing a lot more of it come out too, which is that and I know some have said, we'll build an AI agent to replace all associates. I actually don't believe that. It's kind of like the co-pilots for engineering. A lot of the grunt work can be replaced, and any good engineer, everyone's using it. You need to quickly look at it and sanity check, is this high quality or not? So if you're not very good at coding and you're just using the autopilot, that will be a recipe for further atrophy and weakness. And then years from now, you will be even a weaker coder than you are today, and you'll be even more dependent, and you will be like even more useless. So I kind of see that as an investor too. So if you don't have the skills and you're relying on all this data and technology, the reality is, I think no investor I've met is really that accurate in forward prediction, in predicting the future. Hindsight is somehow very accurate, very precise, very articulate in explaining how did we get from there to here. So eloquent. But predicting the future, if you're just so good at predicting the future, you're done. You just pick all the future winners. You're done. You wrap it up. You go home. Like you don't even need a fund. You just invest and you're done. So the reality is, and they have all the data and thing at their disposal. It's really hard. So you're trying to take like the best of the best people, best of the best investors. Still, it's like an art and so involved. The heuristic is so long, and you're trying to replace, and that's not happening. But I think a lot of the base work around consolidating like simple external data, and so but that's just like coding. The base layer of coding can be replaced and it's much more streamlined. So you need a much smaller team. But if you don't have the driver knowing exactly what is quality, what is not, then that all like veers off course rapidly.
I've talked to several fund of funds, and they face the same issues that funds face. They have to go raise capital. They have to go find great investment opportunities. These days, how are you spending your time between raising capital and deploying capital?
Yeah, we're evergreen. So I think that the answer is I don't think of it as raising capital. You should always be raising, yet never be raising. It's kind of like one of those Vulcan thoughts, which is, we're not together, but we're never apart. So I'm always raising, I'm never raising. It's because I think venture shouldn't be so cyclical. There's this fund of fund that's raising right now. It's going to raise, and it's going to raise again in 3 years. So like, there's this weird vintage, whereas great startups and funds are just continuous. Why are you so vintage based? So I'm trying to break the model in that and educating. I know I can't change the mind of institutions, but I'm trying to educate families because they have a much more flexible to think of it as more a continuous process. Don't think of it as my one allocation into venture every 3 years. Think of it as how do I just invest in venture as a part of my strategy as a overall, and then therefore that's evergreen. And I think that's the group that I'm assembling, and that's a smaller group, still large enough, but that takes time to convert. And I think that's the difference of view of approach that I have for building the fund of fund.
And then for emerging managers or VCs in general, GPs, how many do you feel like are pursuing you, or how many do you feel like you have to pursue them?
At the beginning, it's obviously we were pursuing them. We were letting them know, hey, we exist, because last year was our first year. They're like, we didn't exist before. Interestingly, and my partner has some data on this, towards the last quarter of the year, so it wasn't halfway, but kind of the last quarter, it flipped where the majority was inbound, because word gets around, like that we deployed, say, we deployed between 1 to 10 million. We deployed 30 plus million in the first period, and we're going to increase that maybe 30, 50 continuously. So once word started to get around that you have a quality LP that knows how to engage, give you quality feedback, and is positive signal to others, like almost after we invest, a lot of other families join in, they closed around, then we started to see some more inbound. And we haven't done any marketing. It's hard to promote yourself as a fund of funds. So, but yeah, we started to see that transition in the last quarter.
I've heard a institutional LP say that they will only pick, and this sounds like an obvious statement, VCs or emerging managers where they believe that is their final job, meaning that's the last job that they'll ever do, venture capital. Do you think V0 and what you're building right now could be your final job, and that is something that you want to build for like decades?
That's interesting. I don't think of it as a job because the role is ever changing. It's not a job. There's something to be built here because it's fundamentally, should things change? And I think about, so I feel like I'm driving towards change. Once the change is achieved, is there something else I want to change? Maybe. So I'm not going to preset. My job is already ever changing. So that's already like, is it my final job? No, because I've already evolving my job. But the change I'm looking for is, are families investing as much in venture capital as they should, given their portfolio holdings? And until that changes, I'm going to keep pushing on that. Second, the old fund of fund model of kind of raising capital, deploying in that way, is that the right one, or should that evolve? And until I see all the great emerging managers that I think deserve to get funded, immediately get funded so they can do their job. Why do I want them funded so fast? Is because that's not their job. I don't think their job should be fundraising. Just like a founder, why are they fundraising? Is that their job, or is their job to build a great product and service for the customer? Like, kind of, that's a distraction, and that's a skill. You could be good at it. You can still fail being a great fundraiser and building a shitty company. So that's like a recipe for disaster. Same for a fund. You can be great at fundraising and actually just suck. So I feel like let's remove the fundraising part to be just, are you good or not? Do you have a great product? Do you have a great service? Great VCs know how to identify that. You don't have to convince them. They can look at it, be like, yes, you do. I'm giving you money. Do you have that dynamic with LPs? It's like, yes, you're a great GP. I'm going to give you money. I can see past the track record. From this point on, I know that you're good. They have difficulty with that. Until that challenge is solved, I'm still going to be working at that. So I would say for the next period of time, given the pace of change, I'm still being doing that for the next few years. And then as the change starts, ask me again once you start feeling the change, and then I can update that answer. But at least for the next few years, that change it's been happening, but very slow. So yeah, still a lot of work to do.
Final question around the LPs, especially family offices, the ones you interact the most with. How much more do you think they should be in venture, or how much over or under allocated are family offices generally?
That's so hard because I'm very biased. I'm very confident in venture because of my experience and because my outlook of the future. But I think in families, and because the family dynamics is so different. If you're a very senior level, like your 6th or 8th generation, it's so sharded that the power dynamics in the family creates its own inertia. It's kind of, being at a big tech company, there's internal politics now. When you're very close to the top, meaning you're the first gen, you're absolutely going to make solid decisions. Your second gen, you're still very close. Second, third, like you're very, you've known the patriarch or matriarch, and you're close enough to be like, oh, this is how we started, and like you have a visceral feel of risk and reward. You know that before the family became so famous and powerful, someone took risk, someone had the hustle, someone had to build up from nothing, someone didn't inherit it. So you know that, you embody it, you got that DNA. By the time it gets like much later, it's so far removed, you may or may not know that internally. So I think that it's a complicated answer because no families are the same, and definitely the family dynamics could apply. But in an ideal world where you're like, if it's super clean, which is rare, you're first gen, you're like, you've made your own wealth. Should you have a lot in venture? Yes, I think you should. You should train yourself to have the appetite to bet on like venture, because venture represents growth. It's one of the growers in the GDP. It's not optimizing, it's not harvesting, it's not leveraging your position of capital. It's like true growth and creation. For humanity's sake, yes, I think that like you should do that as a combination of like social impact. So I'm very strong believer in that the allocation for that within the alternative portfolio, I would allocate 50% to venture in the alternative portfolio. Why? It's because I guess it's because I feel satisfied with a certain level of wealth for myself, that I don't need to keep chasing infinite number, that I would rather have infinite impact, to know that the bulk of my like resources after all expenditures, my investment dollars is going to things with very high impact. Like that's what I care about.
Fascinating. And then for those funds that you have invested in and the funds that you plan to invest in, is this international, or are you focusing on certain geographies?
Just like a GP, I think my focus will be the US only, just because that's my background, 100%. Like, what is my expertise? In the future, as we have other partners, maybe that expands, just like a partnership. But right now, that's where my network and expertise line up. So that's where I'm focused.
Fascinating. Well, I have so many more questions, but just out of the sake of time, I want to go into some rapid fire questions. I know from the 20-minute VC that your favorite book is Meditations, Marcus Aurelius. Are there any other books you recommend?
Recommend versus favorite is different. I think a new favorite book for me, it's kind of like shows my evolution, is Brene Brown, Atlas of the Heart. Like as a critical thinker, what I've realized that I want to invest in is showing the founders that like it is an emotional journey of the startup too, and part of it is like having the emotional support and understanding. You don't always get that from family, because they're seeing you from afar. They want to see you on holidays. They're like, oh, you should work less. No, but as a board member and an investor, you can be like, I get what you're going through. I'm not here just to pressure you for performance. So that book's impactful for me because I want to be able to express like, I know it's really hard to go through this emotionally, and the sacrifices, and like you're sacrificing time with the kids. Like all these have to add up for something. You're constantly asking, am I doing enough? Like it's so hard. And that it's given me more language of empathy, which is one that haven't in the past, when I started my career, brought into the boardroom as much, as like empathy, because like everyone is there to like push. And then so that's a new thing I found I really value. And I found like helps founders like really kind of bring out the best in themselves, because no one's like a machine. So like the human connection is important, and something that book's helped me kind of put some more depth to articulating that.
Fascinating. Another podcast I really enjoyed that you were on was, I think, the Open Source podcast, and you actually talked about why you named the company Blameless and how you all approach things. And I feel like this approach to Blameless, and also what you just said, is the EQ aspect of Lyon Wong. Favorite movies?
Favorite movies? Matrix is one of my favorite movies. The first Matrix is still one of my favorite movies. Yeah, and in terms of series, I think I like the utopian world universe of Star Trek is one where it's just like a high integration, especially when we look at AI as like a intrusive force like the Matrix is going to dominate over you, versus, the ship's computer and the AI like data is there as your friend. Like I believe in that companionship possibility, friendliness with AI. Maybe it's naive, but yeah, that's the world of integration with artificial intelligence I would like us to see. So that those two are kind of core anchors, even though they represent kind of two versions of the future.
I'm glad you mentioned that, as opposed to the Borgs, which is we shall assimilate you, and the robotic aspect of that. Favorite travel spots?
So many. I do have appreciation recently for Latin America. I think it has so much variety, like within those regions, so densely, like they're so close yet so different. It's been really fascinating, slowly uncovering that and seeing the like just and also the food is just so good. But separate from that, the culture is so rich yet so adjacent to each other. It's a place I find I can go back to each place and it's very different, and they're so close. So it's been a fascinating region for me to discover.
Favorite leader, whether it's present or historical, business or political?
If you do Zoom with me and I have my real wallpaper, you'll see like behind me is like a poster of the Enterprise, or not a poster, but a metal creation of that. And I do think that type of dedication, being one of the, like being a really building a great crew, it's not about an individual leader. I do recognize that leadership is something absolutely essential and needed, but really being able to create the leadership amongst the crew, being a member of the crew and seeing them rise up as leaders, it sounds corny, but it's very much what I strive for. So while fictional or utopian, and the captains of that show, and there are multiple, all for different reasons, that's the type of leadership style, which is like your dedication to your crew, to your mission, and it includes all that it entails, the adaptability. You're not just barking orders, you're not just fixing things, you're developing a ship with a crew that is world class, and you're evolving. And that's something to be very proud of, and that's always been an inspiration and continues to be.
Fascinating. I didn't think I would ask this, but now, are you Captain Kirk or Captain Picard?
That is neither, because there are aspects of both that I find like sometimes I definitely have the Captain Kirk mentality of like, I don't care what the odds are. I always get the odds quoted to me. I'm like, just can it be done? If it can be done, then I'll be the one to do it. Like, why do I need to calculate the odds? Like, I'm just gonna do the thing that can be done, if it's just possible. So in that aspect, I feel like, okay, definitely feel like that. But then there's the like, Captain Kirk is so cool, so like great with the ladies, which I'm absolutely not, and like he's so suave and like can mingle with aliens. So I definitely don't have that. I'm much more reserved, like Captain Picard, of like thinking through something and creating a system and maybe even kind of articulating it in a more like abstract way. So that I think is more similar of the thought process. But occasionally the defiance of like against the odd mentality, I definitely have that. But Kirk overall is he's much more, great with women than I've ever been.
I think you'd ace the Kobayashi Maru. I think I got that right. And then last and final question is, in 2016, someone asked you, when do you think there will be mass widespread adoption of autonomous vehicles? And you said, I think it will be 7 years. I think you were pretty right in the sense of Waymo. Like, Waymo is a real big thing here, and it's growing. When do you think everyone might be using autonomous vehicles?
I think it's actually more than I think it's more than Waymo. I think I think people are missing that, like Tesla with the autopilot, it's not autonomous, but it's so close that it's kind of more like a regulation thing, but you can trust it to drive to a certain degree that's well beyond like a dumb cruise control. So I think we're actually there, and you can go buy a Tesla and turn the autopilot on, and so I think we're there, except that it doesn't sound like the fully no driver, but I think it's capable. So I think like both the technology and the adoption access point is there. It's kind of like regulations are always slow to catch up, labels are slow to catch up, but if you just sat in a Tesla autopilot today, I think that's close to the vision I imagined an autopilot could do 7 years ago. So I would say like it's here now.
Nice. I did find that prediction to be wildly prescient. Lyon, it has been great chatting with you. It's been great knowing you through the years since our days beginning business school together to seeing you go through startups and venture capital and building V0. Wishing you and your team incredible success at V0, and hope you have a fantastic 2025. Thank you for joining us.
Yeah, thanks, Tim.